Next, change in method of depreciation. The consistency principles requires that the depreciation method should be followed consistently from period to period. That means if you follow straight line method in 2019, the same method should be followed in 2020 also, unless there is a change in the expected pattern of consumption of those future economic benefits related to that asset, or the method is changed in accordance with the statute. If there is any change in the pattern of consumption of future economic benefits related to that asset, you can change the method from one method to another. And also, if that change requires in accordance with the law or in accordance with the statute, the method of depreciation can be changed. If there has been a significant change in the expected pattern of consumption of future economic benefits related to the asset, the method should be changed to reflect the changed pattern. Or if the law requires the change, then we can change the method from one method to another. And if there is any change in the method of depreciation, that should be accounted as a change in accounting estimate. That is the change in accounting estimate, not as change in accounting policy. Previous in accounting standard, it was treating like change in accounting policy. Now the new accounting standard says that it should be treated as a change in accounting estimate. So we need not calculate retrospective recalculation of depreciation. We can calculate the depreciation under the new method prospectively. We will see an example. An asset was purchased for rupees 10,500. Residual value of that machine rupees 500. Useful life 10 years. The company decided to change from straight line to written down value at the rate of 25% after 2 years. The company was following straight line method for 2 years. After that, they decided to change to written down value method at the rate of 25%. Cost of the machine 10,500, residual value 500, and therefore depreciable amount is 10,000, useful life 10 years. Therefore 10,500 minus 500 divided by 10 years. That means 10,000 divided by 10 years. 1,000 rupees per annum, that is the depreciation under straight line method. And we provided depreciation for 2 years, and therefore 2 years depreciation 1,000 into 2, 2,000 rupees. The book value after 2 years 10,500, that is the cost, minus 2,000 rupees, that is the depreciation till date. So 10,500 minus 2,000, 8,500, that is the book value after 2 years. Now the company decided to change the depreciation from straight line method to written down value method. Now we can calculate the depreciation for the third year on this 8,500 on the book value. 8,500 into 25%, 2,125. We need not go for retrospective recalculation. We can calculate the depreciation under the new method from the date of change on the book value of the asset. So whenever a depreciation method is changed, calculate the depreciation under the new method on the book value from the date of change. That change is accounted as change in accounting estimate, not as change in accounting policy. Next, change in historical cost of the depreciable asset. When the historical cost of an asset undergone change because of price adjustment or something, when historical cost of an asset is changed, the depreciation on the revised depreciable amount is to be provided prospectively over the residual useful life of the asset. Here also we should calculate the depreciation prospectively. We need not go for retrospective recalculation. We will see an example. A Limited has an equipment purchased 2 years ago for rupees 3,50,000. The residual value of the asset was estimated to be rupees 20,000. The useful life of 12 years was estimated when the asset was purchased. The company follow straight line method of depreciation. Due to price adjustment, the cost of the asset is now increased by rupees 50,000. Find out the new depreciation. The cost was rupees 3,50,000, residual value 20,000, useful life 12 years. After 2 years of depreciation under straight line method, the cost of the asset increased due to price adjustment. Find the depreciation for the third year. So first 2 years depreciation under straight line method. Cost of the asset minus residual value divided by useful life. Cost 3,50,000, residual value 20,000, and therefore depreciable amount 3,30,000. Useful life 12 years, and therefore depreciation per annum 3,30,000 divided by 12, 27,500, and therefore depreciation for 2 years 27,500 into 2 years, that is 55,000. And therefore book value after 2 years, cost minus depreciation till date, 3,50,000 minus 55,000, that will comes around rupees 2,95,000. And now the company decided to make some price adjustment in the cost. Price increased. Therefore add 2,95,000 plus 50,000. Now the book value becomes 3,45,000. We assume that the asset will fetch same residual value. The asset will get same residual value at the end of its useful life. Therefore, deduct the residual value from the new cost. 3,45,000 minus 20,000. Depreciable amount is now 3,25,000. Remaining useful life, we already depreciated. 2 years of depreciation we already provided. Therefore, remaining useful life is 10 years. Depreciation for the third year, we follow the same straight line method. 3,25,000 divided by 10 years. Depreciation for the third year is 32,500. Repeat. The cost was 3,50,000, residual value 20,000. Therefore, depreciable amount 3,30,000. Useful life 12 years, and therefore depreciation per annum 3,30,000 divided by 12, 27,500. Depreciation for 2 years 27,500 into 2, 55,000. We were providing depreciation under straight line method. Same depreciation for 2 years, 27,500 into 2, 55,000. Book value after 2 years, the cost minus depreciation till date 3,50,000 minus 55,000, that is 2,95,000. Now make a price adjustment. 2,95,000 plus 50,000. Now the book value becomes 3,45,000. Deduct the residual value 20,000. We assume that the same residual value, 3,45,000 minus 20,000. Depreciable amount is 3,25,000. We already provided 2 years of depreciation. Therefore, remaining useful life 10 years. Therefore, depreciation for the third year 3,25,000 divided by 10, 32,500. Next, change in useful life of the depreciable asset. If it is considered that the original estimate of the useful lives requires any revision, the unamortized depreciable amount of the asset should be charged to revenue over the revised remaining useful life. We should calculate the depreciation during the remaining useful life as per the revised remaining useful life. We will see an example. A Limited has an equipment purchased 3 years ago for rupees 9 lakh. The residual value rupees 1 lakh is estimated. The useful life of 8 years is estimated. The company follows straight line method. Due to change in technology, the company estimates that the asset will become obsolete in another 2 years time from now. Find the new depreciation. Originally, the company estimated 8 years useful life. After providing depreciation for 3 years, the company estimates that the asset will become obsolete in another 2 years. Cost of the machine 9 lakh, residual value 1 lakh, therefore depreciable amount is 8 lakh. Useful life 8 years. So therefore depreciation per annum 8 lakh divided by 8, 80,000 rupees. The company provided depreciation for 3 years. 80,000 into 3 straight line method 2,40,000, and therefore book value after 3 years 8,40,000, 9 lakh minus 2,40,000, that is 6,60,000. The book value after 3 years, cost minus depreciation till date. Cost was rupees 9 lakh, depreciation till date for 3 years, that is 2,40,000, and therefore book value after 3 years 9 lakh minus 2,40,000, 6,60,000. The residual value, we estimate that the asset will have same residual value, and therefore depreciable amount is 6,60,000 minus 1 lakh, that is 5,60,000. And we estimate that the asset will become obsolete in another 2 years. So therefore remaining useful life, revised remaining useful life is 2 years. So depreciation for the third year 5,60,000 divided by 2 years, that is 2,80,000. Depreciation for the third year is 2,80,000. We'll see one more question. A machine costing 60,000 depreciated for 3 years under straight line basis, assuming 10 years life, remaining useful life reassessed as 5 years. The cost was 60,000, already provided depreciation for 3 years. 60,000 divided by 10, that was the useful life, 10 years. 60,000 divided by 10, 6,000 rupees per annum depreciation, already provided for 3 years. 6,000 into 3, 18,000. Therefore book value after 3 years of depreciation 60,000 minus 18,000, that is 42,000. We originally estimated 10 years of useful life. Now we estimate that the remaining useful life is 5 years. Already provided 3 years of depreciation. We now estimate that the remaining life is only 5 years, and therefore depreciation for the fourth year is 42,000 divided by 5 years, that is 8,500. That is the depreciation for the fourth year. Next, revaluation of depreciable asset. In case of a depreciable asset are revalued, the depreciation based on the revalued amount on the estimate of the remaining useful life of such asset should be provided. The remaining depreciation should be provided on the revalued amount. The revaluation may be upward revaluation or downward revaluation. Upward revaluation means increase in the carrying amount of the asset. If there is an increase in the carrying amount of an asset arising due to revaluation, that should be credited directly to revaluation surplus account, revaluation reserve account. It should not be directly credited to profit and loss account. It should be credited to revaluation surplus or revaluation reserve account. But there is an exception that the increase should be recognized in the P&L. Increase can be credited to P&L to the extent that it reverses a revaluation decreases of the same asset previously recognized in the P&L. That means if the asset was revalued downward in previous years and that downward revaluation is debited in P&L, then when a revaluation increase arises, To the extent the revaluation debited in the P&L, that can be reversed. That means that can be credited to profit and loss account. And the remaining revaluation increase should be credited to revaluation reserve account. For example, in 2019, the asset was revalued downward and rupees 2 lakh debited in P&L. In 2020, the asset made a upward revaluation of rupees 10 lakh. Then, out of this rupees 10 lakh upward revaluation, rupees 2 lakh should be credited to P&L, because in previous year there was a downward revaluation that was debited in P&L. That should reverse first, and that should be credited now to the P&L, and the balance 8 lakh should be credited to revaluation reserve account. Next, revaluation decrease. If there is any downward revaluation, any decrease in the carrying amount of the asset arising due to downward revaluation should be charged to P&L, should be debited to P&L. Here also there is an exception that the decrease should be debited directly to revaluation surplus to the extent of any credit balance existing in the revaluation surplus in respect of that asset. For example, in 2019, the asset was undergone an upward revaluation of rupees 2 lakh, and therefore rupees 2 lakh is credited to revaluation reserve account in 2019. In 2020, the asset undergone a downward revaluation of rupees 10 lakh. Now, first we should adjust the revaluation surplus already existing related to that asset, that is rupees 2 lakh. That should be first debit that rupees 2 lakh in revaluation reserve account, and the balance rupees 8 lakh should be debited to profit and loss account.